Hey everyone, Happy New Year to you. Thanks for tuning in to our December 2025 Investment Committee Update. I'm Chad Smith, a managing partner at Reveille Wealth Management and part of our investment committee. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. Stocks globally were slightly higher in December, with international and emerging markets showing continued strength and outperformance. This has been a characteristic throughout 2025. We've been highlighting all year the attractive opportunities within international markets, and Stephen is going to provide an update on where we stand in the rotation that is clearly underway and, in our view, reflects just the beginning of what could be a pronounced cycle. And while the Federal Reserve did vote to cut the Fed funds rate another quarter point in December, longer-term interest rates rose slightly, and bonds traded slightly lower for the month. While the market has presumed that President Trump will soon nominate a new chairperson at the Federal Reserve who aligns with his perspective on cutting rates further, we believe the path to lower short-term interest rates may be hindered by stubborn inflationary pressures. The equity market environment remains favorable in the near term, driven by continued long-term uptrends, shorter-term seasonality, and ongoing signs of constructive rotation into other areas outside of just large-cap U.S. stocks. Now, that said, we do expect more volatility in 2026 due to partisan posturing and the fact that midterm election years have historically been more volatile. And with that, I'll now turn it over to Stephen to take us through this month's review.
Okay, thank you, Chad, and Happy New Year to everybody. Hope everybody had a wonderful holiday season, and welcome to 2026. So the slates are now wiped clean, and all things have been made new once again. So we're going to begin our discussion today talking about some market rotation. Chad mentioned it already in the preview that while the stock market was up modestly in December, international stocks led the way higher. And not only did international stocks lead in December, they led the whole year, which is ironic given the way that we entered into 2025. Or was it? So to set the stage for that discussion, I want to go back and I want to play a short clip from our January review that we played at the beginning of last year. So listen to this. At the end of January, we saw that index very close to starting a new uptrend. Somewhat ironic given the concerns market participants seem to have over potential tariffs and trade wars. So I do want to take you back briefly to what happened in the market in the international indexes after Trump's first election victory. So they traded lower. This index traded lower in the aftermath of the November election in 2016 around these same concerns. Tariffs, trade wars, those concerns were very palpable. But that narrative and that going concern at that time, it did not derail a very strong advance in this asset class in 2017. This was one of the strongest performing asset categories of that year. So I'll ask the rhetorical question. Could we see a reprisal of 2017 in 2025 for these international stock indexes where they rally despite concerns over tariffs? Wouldn't you know that despite some of the same tariff and trade war concerns that we had in 2025, just as the market had faced in 2017, U.S. stocks underperformed their international counterparts in 2025. So here we're looking at a chart of the S&P 500 relative to the EFA index, the Developed International Stock Index. And you can see how going into the election in 2024 that U.S. stocks were outperforming their international counterparts, right? This was happening as Trump's odds of winning the election were also rising, right? And as we saw in the clip from the January video from last year, the concern around tariffs and trade wars were causing a lot of investors to dump their international stock positions. Ironically, the top in this ratio, it occurred within a few weeks of Election Day in 2024. And by the time Trump was getting inaugurated in January of 2025, this trend had already started to reverse, where U.S. stocks were underperforming their international counterparts. But when you zoom out, you can see that from a longer term trend perspective, nothing has changed yet. So if you've been with us for a while, we've been talking about this one for a number of quarters, even a couple of years. That U.S. stocks have been outperforming their foreign counterparts now for over 15 years. And fundamentally, U.S. stocks, at least the S&P 500 index, it's been trading at one of its richest valuation levels in history. International stocks, in contrast, have been trading at one of their lower valuations in history. So we've been attentive to the idea that at some point, this relative trend, it should start to shift, right? And while we did see some outperformance from international stocks in 2025 for the first time since 2017, we're still waiting to see the longer term trend here flip, which would be which would end one of the longest periods of outperformance by U.S. stocks over international in history. And this is something that investors need to be attentive to. Now, when we look at this same ratio, but we adjust for the effect of the largest companies in the U.S., we see a different story. So the S&P 500 index, and we've discussed this in a number of prior reviews or other commentaries that we've put out, but it has never been less diversified than it is today. And it's a market capitalization weighted index, which means that the largest companies, they carry a proportionally larger weight and influence on the index. Well, the largest 10 stocks in the index now comprise over 40% of the index. I think it's actually 41. But at the peak of the dot-com bubble, it was just over 25%. Before the financial crisis, it was around 20. So actually, let's go on a quick little tangent here. Let's bring in this graphic here just for a quick second to visually reinforce this point. So the S&P 500 is incredibly concentrated, with the largest names here essentially all being technology stocks. The exceptions are JP Morgan and Berkshire Hathaway, two financials. But this graphic here shows the cumulative market cap of the largest 10 companies in the cap-weighted S&P 500 index at the start of these various calendar years. So in 2025, the beginning of 2025, the largest 10 stocks began the year with just under a 40% weighting of the entire index, finished at over 41. But look at how that compares to these prior decades. So you'll notice that often some of these names will change as well, but you consider a company like ExxonMobil that would have been on this list in 30 prior years. It dropped out. It's not here anymore as one of the largest 10 stocks in the index, right? And since Exxon's prior high that it had made in 2014, its market cap has grown by about 16%, just over 1% per year. General Electric, right? General Electric was at one time the largest company in the world. In 2000, it was the largest company in the world. But the stock has made virtually no progress in price appreciation since then. And I know it's hard to think about, but what happens to the S&P 500 index if we see some of the leading components of the S&P 500 index today face similar outcomes to that in the future? That's some serious food for thought. But let's digress. Let's get back to comparing the median U.S. stock, this equally weighted index, to international, right? And so that's what happens when we adjust for these largest components. We go to this equally weighted index where every company is going to be 1/500th of the index, regardless of actually how large it is. So we see that the relative trend in this ratio, it's already started to roll over in favor of international stocks. I think it's probably only a matter of time before we see a similar outcome in the cap-weighted index relative to international. Now, we're already seeing this same trend roll over U.S. equities relative to emerging markets. So this chart is zoomed out here just a little more, goes all the way back to 2000 when the tech bubble was bursting. So not only were U.S. stocks falling at that point in time, post-dot-com bubble, on an absolute basis, but they were falling on a relative basis as well, right? The S&P underperformed the emerging market index for a decade. And I still remember the early days of my career, almost 20 years ago, back in here, when I would meet with clients regularly and their 401ks would be filled to the brim with international and emerging market stock funds. That's where the strength was. That's where the money was being made. They didn't want a bunch of lousy U.S. stocks in their retirement accounts at that time, right? That was back here, right? That was back here. Now, hardly anybody wants to own emerging market stocks, right? They consider U.S. stocks to be much safer. So file that away in your mind. But we've actually got emerging market stocks now leading. They are now leading. This trend is changing as we speak. And one thing we've seen with these trends is that they tend to be more structural in nature. They tend to last for a long period of time. Are you prepared for that? Now, let's pivot to the bond market. So everyone's on pins and needles. They're waiting for the announcement of the next Fed chair. And while this person is expected to be quite dovish or favor lower interest rates, looser monetary policy, I'm skeptical as to how much this new Fed might be able to further lower interest rates. So the Fed's current policy range is between 3.5% to 3.75%, the effective rate kind of in the middle. Well, with the 12-month Treasury bill and the 2-year Treasury note yield just under 3.5% and a kind of holding steady, it would seem that the bond market is suggesting that we might not get any future rate cuts. And surprisingly, and here we're looking at the 12-month bill, right? It's 1-year U.S. Treasury yield here. The 2-year and the 10-year, right? The Fed has cut short-term interest rates 6 times since September 2024, right? From 5% to 3.5%. Okay, so X kind of marks the spot here on when that first rate cut occurred. So what do we see? Yields moving lower in lockstep, headed into that rate cut, coming lower. But since then, we have gotten 6 rate cuts. The front end of the yield curve, the 1-year, the 2-year yields, they are maybe down some since that period of time, but not a lot, right? They had already moved down from 5% to where those yields were, to almost 3.5%, before the Fed had even started cutting rates. They hadn't even cut rates yet, and the 1-year and 2-year were already down here, right? So the Fed has now essentially caught up to what the bond market had been pricing in. But these longer term rates, the yield on the 10-year, those yields are higher today than they were before the Fed even started cutting. Riddle me that. I thought we had rate cuts, right? These yields, the yield on the 10-year is actually over 0.5% higher than they were before the Fed lowered rates. So having longer term rates, i.e. mortgage rates, come down would likely provide a more meaningful benefit to the economy. So it's going to be interesting to see what direction these longer term yields take. Are they going to continue to hang out here? Are they going to come down? Or are the inflationary pressures that we're facing going to challenge their ability for these rates to fall? Might they even rise more? We'll see. Now, what might we encounter in this market for 2026? So as we've mentioned in some of our recent updates, and we're still in the midst of the strongest 6 months of the year on a historical basis, from November through April, strongest 6 months of the year. But the midterm election years are the most volatile of the 4-year presidential cycle, right? An early source of market consternation could be the expiration of this temporary funding bill that Congress passed before Thanksgiving of last year that's carried us through the holidays. It expires at the end of January. And I really don't see a whole lot of reason why Republicans and Democrats are likely to come together to try to extend it even further without some sort of meaningful rancor. So, thinking back to the recent past for these midterm years, 2018 was a volatile year. It ended with a considerable market pullback in Q4. The market was down about 20% in the fourth quarter of 2018, bottomed on Christmas Eve. 2022 was the first year in modern history that both stocks and bonds fell by over 10% in a single year. Right, and I present all of this with the most important caveat that while these are historical tendencies, it does not say that this is the roadmap for where the market's going in 2026. We don't want to just blindly trust these analogs. We don't just retreat to cash when the broader market trends remain favorable, but we have to continue to manage risk along the way, and that is as important today as it's ever been. So last thing here, as bumpy as the midterm cycle is, right, and it still has that peak in April historically, and the summer's pretty volatile, the strongest portion of the entire 4-year presidential cycle, it begins in Q4 of this year, running through the middle of next year. So that's like the carrot of 2026, like other midterm years, it could be fairly volatile, but headed into 27, historically is the strongest season of the 4-year presidential cycle. All right, let's move on, and we're going to go through some charts of these key asset classes, starting with large cap U.S. stocks. Looking at the S&P 500 index, it remains in an uptrend. Mid caps also in an uptrend, although they're still underwater from those former highs back in late 2024, that post-election surge that we had in 2024. We're still just underneath that, right? Very close to making new all-time highs, but not yet. Small caps, Russell 2000 index, they also remain in an uptrend, and importantly, they closed the year at a new all-time high. Now, this could be a massive development. When we look at small caps on a relative basis versus large, we see them potentially finding support at a logical level. And that's the level where they essentially bottomed relative to large cap stocks at the peak of the dot-com bubble, right? This was 25, 26 years ago. when small caps became leaders. Will they become leaders again? Right? Well, this is as good of a place as any if they're going to get started. Now, I want to show you this chart of the developed international stocks very quickly, right? New all-time highs here, solid uptrend, pulling away from those former highs that dated all the way back to before the financial crisis. I want to show you this first, right? Now, I want to come back to this chart of the Russell 2000. Are we going to get a sustained breakout here in the small caps? Right? I'm going to say that it's much more likely that we do get a sustained breakout in the small caps as long as on a relative basis we see this one dig in. If it does dig in here, and I don't know if this is a chicken or the egg type scenario, but this one probably digs in and starts to move higher because now there is technical support in the small cap index itself breaking out to new highs, kind of like what we saw in the international space, in the developed international space. Now let's move on to emerging markets. Had a very strong year in 2025 despite the aforementioned tariff and trade war concerns. So unlike the developed international index that we saw earlier and the Russell 2000, which we just saw, this one has yet to break out to new highs. So a breakout here would be a very big deal. But ironically, we've already seen the relative trend in emerging markets versus US move to favor emerging markets. That's already happened, but the index itself has not yet broken out, right? Perhaps the fact that it is now breaking out on a relative basis, that the trend is now favoring emerging markets over US equities, maybe that is enough of a catalyst to push this index beyond that former 2007 high. Now let's move on to the bond market. U.S. aggregate bond index still remains in an uptrend. It's still been a good environment for bonds here, but this one has been grinding sideways here for several months. And I wonder if it's got a big move in store for 2026. I guess we're going to have to wait and see. Commodities, now in an uptrend after spending the last few years just kind of trapped in a sideways range. They are now in an uptrend. They've taken out that former resistance, moving back to multi-year highs here. Real estate, however, Dow Jones Real Estate Index, it's still trendless, right? Not much positive to say about the REIT space at the moment. Now that's it for our big picture overview. So if you're watching this public version here on YouTube, this is where our review is going to conclude. For our clients, our review is going to continue, and we highlight the holdings that we currently have within our model strategies. If you're interested in learning more about our model strategies, send us an email to info@reveillewealth.com, and we'll follow up with you and share more. But for now, I'm going to pass it back to Chad for a quick recap, and then I'll leave us with some final thoughts.
Thanks, Stephen, for that update. So to recap, stock markets were slightly higher in December, with international markets leading the way. Global equity markets continued their longer-term uptrends during the month, with further signs of rotation into areas such as value stocks and small and mid-cap stocks. Despite another interest rate cut from the Federal Reserve, longer-term interest rates rose slightly, and longer duration bonds traded slightly lower for the month. While short-term seasonality is a tailwind for the stock market, and healthy signs of market rotation is constructive for sustaining the current bull market, we do expect increased volatility in 2026, driven by the midterm election cycle and partisan posturing. With that, Stephen, any final thoughts?
Thanks again, everybody, for joining us for this month's review. We hope everybody had a wonderful new year, and we wish nothing but great things for you here as we go into 2026. As always, if you have any questions, please feel free to send us an email to info@reveillewealth.com. We look forward to serving you in the year ahead, and we will catch up with you next time.